Let's look at next how a company decides on a dividend policy decision. And I'll go through the key factors they go over in the textbook. Okay, so each company is going to set a policy based on their specific goals or their situation. And it essentially is going to also consider their target shareholders. Because some shareholders like dividends, some shareholders do not, and you want to see who you want to attract. So the first thing is they will consider whether a residual theory is useful for the company. And the positive that we talked about is that your NPV projects that are profitable are done. Okay, which is good for the company. The problem is that you have a variable dividend, which is not good for the shareholders. At least the ones that want it. They want a flat, stable one. The book discusses something called the bird in hand theory. And what that is it says that dividends are safer for an investor. And the reason for that is because they're paid now. Okay, you could say, well, let's reinvest and get a larger amount of net income. The problem is that net income is in the future. So there's time value of money, and there's also the possibility that it may not occur. So it's riskier as well. So that's why some investors prefer dividends. The next is the tax considerations. This is something unique to country and tax brackets. But this is, I'll just leave it at that you do have to consider the taxes of your shareholders in setting your policy. And agency costs is another thing mentioned in the textbook. And what they're saying here is that excess cash can result in poor investment decisions. And so you could say, well, management and shareholders are on the same page. They both want to increase the value of the company, and that is true. But managers might behave differently when they've got billions of dollars cash. They might all of a sudden start approving projects that are interesting or they're pet projects, and it might have been better to pay that out as a dividend. The next one is trading costs, which aren't really that important now, but if you paid a dividend and you wanted to reinvest it, you would have to pay a transaction fee to do so. And the following one is important. It's investment policy rules. And this depends on where you are. In Canada and the US, there are some institutional investors that must only invest in companies that pay dividends. So institutional investors would be things like pension funds. Okay, so they are limited to investing in dividend-paying companies. Just like when we talked about bonds, there's in the pension industry, you have to only invest in investment-grade bonds. You can't buy lower ones. And if you're trying to attract these investors, then you have to consider that. And the other thing we talked about dividends, the textbook talks about, is what we've already talked about, is what they call the signaling effect. Okay, and if you look at a few scenarios, a dividend cut sends a signal that net income may fall. Okay, it may not be true, but that's a signal it sends. What shareholders will say, well, they just cut their dividend. It means things aren't going as well as they expected. And a dividend increase is the opposite. What it says is that income is better than expected.